The next mortgage bubble may spell opportunity. Welcome to this week's edition of the Industry Leader Update by Reverse Focus. The next mortgage bubble, with pending HELOCs written in the mid-2000s, could spell opportunity for reverse mortgage lenders and trouble for, U.S. home borrowers. A recent study by TransUnion echoes what some mortgage professionals have been warning us about in the last year, that there is in fact a coming HELOC bomb that will explode in the next year or two. The study shows that as of the end of 2013, nearly 16 million U.S. consumers hold over $400 billion in home equity lines of credit. TransUnion estimates nearly 15% or up to $70 billion of these accounts may be at risk of defaulting in the next few years. Even more sobering is the fact that more than half of these loans have balances of over $100,000. Home equity lines of credit were quite popular during the housing boom in the mid-2000s. For many people, HELOCs represented a low interest rate opportunity to borrow against the value of their homes, which were rapidly appreciating at the time. This according to Stephen Chayoki, the head of financial services at TransUnion. Now, what is at the root of this HELOC crisis? Well, first, loose lending standards during the housing boom often ignored traditional credit risk indicators and prudent underwriting standards. And second, and most importantly, many of these loans are now exiting their draw periods, typically the first 10 years where interest-only payments were the only requirement. The expiration of this draw period will spell trouble for many borrowers who are ill-prepared for the payment shock, which will come after the EOD or end of draw period. Now, in this example from the study, a borrower who took out an $80,000 HELOC at 7% in 2005 would see their minimum payment increase from $467 per month interest only to $719 per month fully amortized. Stephen Chayoki said, "The financial shock associated with a HELOC payment increasing to cover both principal and interest can cause liquidity issues for some borrowers. This dynamic is driving significant concern in the lending marketplace. The effects could be far-reaching as most consumers today carry other debt, such as credit cards, auto, and student loans, and that could lead to a domino effect in household budgets. Now, looking at the boom years, we could anticipate a continuing slew of HELOC defaults in the years 2015 through 19. In light of this HELOC bubble, some reverse mortgage originators have already begun to focus on seniors who have outstanding HELOCs or lines of credit. Those with lower first mortgage balances and a troublesome HELOC could benefit by refinancing both into a HECM, giving them the cash flow during their retirement years that is needed. Now, those of you watching today may want to check with lead and data providers for such a list and a targeted marketing campaign. Now, certainly many will not qualify due to high mortgage balances, but many will. Today, the reverse mortgage remains a very viable solution, and especially now for those senior homeowners who are facing HELOC payment shock. Now, what are your thoughts on the coming HELOC bubble and crisis and the potential opportunity? Share your thoughts in the comment section below and have a great week.